Hi, everyone. Welcome to the Go-to-Market Lab, the podcast that is dedicated to B2B tech founders and revenue leaders who are in their seed stage, Series A, Series B, Series C, and each of those early stages of a startup's journey where being able to identify your go-to-market strategy is really a science as well as an art, including those pivots that you have to make along the way in go-to-market. Now, in today's episode, I want to do two things. First, I want to give you some information and update as to what we're seeing in the US B2B tech space from an investment perspective, how that's showing up, what that data really means in terms of boots on the ground, what it's like if you are a startup leader, a startup founder who is looking to do a raise, whether it's a seed or a Series C, and what that sentiment is in the investor's mindset. So I want to talk about that. And as an outcome, I want to talk about what really that certain climate that we are in, how that is changing the lens of go-to-market and spoiler alert, the importance of it. So let's get into it. So number one, let's talk about the overall funding climate just as a whole. Early stage funding has slowed significantly compared to the boom years of 2020 and 2021. According to Crunchbase News, while Q1 of this year saw global venture funding hit $113 billion, early stage investments, including Series A and B rounds, actually declined to $24 billion, which is the lowest in at least 5 quarters. That's also leading to increased selectivity. Investors are being extremely selective right now. A report from Valor Ventures reports that to secure a Series A in 2025, B2B tech startups should aim for over, wait for it, $2 million of annual recurring revenue. And on top of that, be able to see 3x year-over-year growth quite consistently. So let's just put it in a nutshell. The days of raising a Series A on a dream, an equipped team, a great pitch deck, and $750K of ARR, those days are long gone. Those days, that is not reality today. Let's also talk about the trend of longer fundraising cycles. The data is showing that it's taking longer for startups to move from a Series A to Series B by extending it by about a year. So it takes about 2.8 years on average to move from Series A to Series B is what we're seeing, which is a record high as noted by Crunchbase. So what does this mean? This means that startups are facing a funding cliff if they can't get to the next round quickly. That's coupled with another thing that we're seeing with investor sentiment being quite cautious. According to PitchBook, while there's been a resurgence in venture capital being driven by AI investments specifically, this surge is really concentrated, if you peel back the layers of that data, in a few large firms, which means that many and most of the startups are facing funding challenges. You add to that the headwinds that are popping up without being expected, geopolitical tensions, trade policies are also creating uncertainties, as well as this never before seen clip of how fast not only technology is advancing, but also the adoption of it is advancing within the public sphere. Let's talk about sector trends. Of course, if you don't know that AI remains to be a hot sector, you've been living underneath a rock for the last year, but let's talk about that in more detail. Over half of the venture dollars in early 2025 were invested in AI-related companies, which means that AI startups can still raise large rounds more easily than others. So yes, that is the case. This also means, though, that the investors do have increased due diligence. The due diligence process is now more rigorous than we ever have seen before. It used to be that investors would be able to look at the technology, be able to spend, week in due diligence and be able to, brush through the metrics and go forward. But now there's taking a lot of scrutiny. Investors expect strong metrics like net revenue retention above 100%, capital efficiency metrics like burn multiples under 1.5x, as noted by Valor Ventures. What does all this mean for the topic of go-to-market? It is everything. Not just that you're thinking about go-to-market as a founder, especially a technical founder, but that you're actually forming that strategy set in reality. In this market, I believe strongly that the go-to-market packaging and where you're able to get a successful balance of product and marketing and sales execution and be able to do that in an innovative way is going to be the competitive advantage. It used to be 20 years ago that the technology, because it was hard to create a software product, was the competitive advantage. It was the moat that you could create, but that's not the case anymore. I mean, my son, my 11-year-old, is creating and learning Python right now to create his first AI product that he's really spec'd out for mom. I was at the doctor's office the other day, and she was just sharing with me that her last patient had said that her 13-year-old is making about $350 a week on his AI technology. So here's my takeaway, is that the tech is not hard, but you do need to be able to market it. And marketing is not, yes, it's going to cost money, but it's also about how you're putting together that market. Anybody could get a product, especially in today's AI go-to-market tool sets, and be able to blast thousands of people with personalized messages, but that is not going to do it. To be able to really think through your go-to-market and pressure test it at the beginning, probably in my advice, before you actually lay a line of code, is going to be important. Now, I also think it's not uncommon that we lay down these go-to-market plans, founders do, who may not have sold before, who have marketed before, with an unreasonable marketing budget that you can't get liftoff with at all, that there's irrational sales assumptions in terms of how long it takes to get a deal into a mid-stage and to close, and the percentage of deals that you do close, how long it takes a rep to ramp in an environment. All of those are assumptions that I've seen business plans not set in reality. So think about it this way. If you got a go-to-market with the wrong ICP in the wrong market, you're packaging your product in a way that's setting yourself up for failure, you may not actually realize that. I did a post on this quite recently and did a couple of graphics to really set in the point that you may not realize that for 12 months, even if you're doing fast iterations on your go-to-market. Why is that? Because even a successful cold outreach campaign will take 3 to 4 months to bake. So you can't pull the plug too early. That also, if you keep switching gears before you're able to let results really happen, that's not good. But you really you can't control the speed of how someone responds to your LinkedIn message or your phone call. They might have other things in front of them. And so it may take 3 to 4 months, even just to get that first meeting. And then from that meeting, you're at the mercy of what that company's sales cycle is, or what their budget cycle is, where their own priorities, other priorities are. And so if you are creating a product with a go-to-market that is under the premise that you're leaning towards a new innovative way of being more efficient and something that might be categorized as nice to have versus a budgeted must-have, this all can mean that whole process from marketing launch, cold marketing campaign launch into deal closure could be 10 to 15 months. So think about if you've launched that and you get to the end, you're like, wow, this got me 1 or 2 customers, but I'm struggling to get any more. This is not repeatable. Hence, I can't get to my 2 million ARR number. That is going to be bad. You're going to have to be in a position to run out of money, which makes you not do the right things for marketing, sales as a result, as well as for the product, et cetera. So I can't say enough that go-to-market really has to be thought through in startups. Remember, I'm just going to call it like it is. I have fantastic venture capitalist, venture VC colleagues, but just remember how that math works. If you're looking at seeds, if you've only worked with seed stage VCs, they're working on math that 1 out of 20, 1 out of 30 of those companies will pop. And so they're not going to be able to devote a lot of times all of the really kind of day-to-day. They're going to give you advice, but it may not be the advice that really is advice grounded on the details and the nuances of your market. What happens when you launch that campaign? What do people say back? And it's really hard to get into the details of those many roadblocks that you're facing on a day-to-day basis at a board advisors meeting. And so really being able to think through objectively your go-to-market has to be your competitive advantage. All right, listeners, what do you think about that? Do you agree with me, disagree with me? Do you have comments? Do you have additional thoughts? I'd love to hear from you. If you found the update in this podcast of value, please send me a note, or comment on whatever medium you're listening to this to, on YouTube, on Apple Music, on Spotify, etc. And I look forward to your comments. Be tuned for the next episode, and I'll see you soon. Take care.